And so that gave rise to the Federal Reserve Act, which created the Federal Reserve, the central bank. So up until that point, here we are, born in 1776, right? Declaration of Independence. We get the Constitution a little bit later. And so here we are, 100 and some years later, getting the central bank put together. So the country ran a long time prior to that. And so in 1913, we have the Federal Reserve Act of 1913. One of its primary purposes with that act was that the central bank, the Federal Reserve, was going to be the bankers' bank. The bankers' bank. Think about that for a second. And you might remember from macro class. A lot of this chapter is going to be kind of review, so I'll go through it a little quicker than what I did in principles class, just to kind of lay down these foundations. Bankers' bank. If the banker has a bank, what is the bank? Yeah, putting deposits in is the big thing, but they might have availability to do loans as well, right? So they're kind of being using the bank like we use the bank. So the banker's bank was, the main thing was member banks were required to hold, or to deposit, let me put deposits that hold, we're required to deposit a fraction of deposits, a fraction of total deposits, on reserve with the Fed. The Fed is our affectionate name for the United States Federal Reserve Bank, the Fed. That's our shorthand. So when you hear the Fed, we're talking about the United States Central Bank, not the European Central Bank, the ECB, or Japan. The Bank of Japan is the Central Bank of Japan. So the Fed is our United States Central Bank. Okay, so this created required reserves. RR. And if we put our equation goggles on, one way to think about this equation would be the total amount of required reserves is equal to the required reserve ratio times the amount of total deposits, where D equals total deposits, big D. So this is the required reserve ratio, is RRR, what I use for little RRR. And, you know, I don't try to use different notation than the bank. Maybe, let me check what the book is using here. They might use R. I can't remember where I got RRR from. I'll try to be consistent. Or if it's in this chapter, it might be in the next chapter. R, maybe I'll try to be consistent later. I'm not finding it right now. Oh, it is RR. Okay, so they use two R. Two little r's, required reserve ratio. So it's a fraction. So for example, if RR equals 0.2 and deposits equal 100 million, then the bank has to hold back 20 million. No big deal. So required reserves, big R, is equal to 20 million. Just a short little example to kind of get our juices flowing. All right, so now, as Jacob was pointing out, if there's a bank panic, it's possible for the Fed to have that money available because they've been forced to hold back some of it. We didn't completely rely on Mr. Potter, Old Man Potter, being a good enough businessman that he held enough back himself, so the government could regulate how much they had to be held back. Yes?
So we talked about it like earlier, but is that what the FDIC thing is? That's something different.
That's a little different. We'll get to that distinction later, but in general, the FDIC protects the depositor's money up to a certain amount, which is currently $250,000, I believe, right now. So that is kind of a government bailout of the consumers, and that way the consumer doesn't really give a rip where they put their money, because they don't have to check into the bank to make sure it's a good bank. Hey, what are you doing with my money? Are you investing in Goldman Sachs, or are you giving loans to that McCullough guy? Because he's a risky guy, and I think there's a good chance McCullough's going to default, right? So if the onus was on you that there was potential risk money that you're putting on deposit at the bank, you'd be a lot more careful about whether you use People's Bank, Wells Fargo, JP Morgan Chase, or whatever, right? You kind of investigate. Hey, what are you doing? You all of a sudden care. But now, as long as you got less than $250,000, People's Bank goes under, no big deal. Uncle Sam's going to cut me a check and make it good. So that is an insurance policy that all the bankers pay into as a part of their operations to cover that part of it. Otherwise, what this does is it just gives a little bit more control that there's more money being held back. If the bank would go under prior to FDIC insurance, depositor might lose some of their money still. But most of the money should be there. It help the banks be more solvent. Okay, any other questions there? That's a good distinction, because it's a little, FDIC insurance is a little bit different than this. All right, so let's take a look at, well, before I do that, let's look at the other tools, I guess. So this is one tool of the Federal Reserve, is the required reserve ratio. They set this fraction, little RR, for each of them. So that would be a tool of the Fed. So for tools of the Fed, number one would be setting the required reserve ratio. Number two would be related to loans. So on the other part of it, they can make loans to member banks if they're in trouble. And that would provide liquidity so that the bank could potentially handle a panic. This is where it's different than FDIC. FDIC covers if the bank goes out of business, if they go bankrupt, then the depositors are covered. But in a bank panic, oftentimes it was just a rumor. And so once people quit coming because they figured out that Old Man Potter actually had the money, or that he was solvent, then it would stop, right? And so all the people needed to know is that, hey, if you need money, the Fed will have the money, or potentially this Old Man Potter can get a loan to make it good. That loan is made at the discount rate. So the discount rate is the interest rate charged. The interest rate, and I use little d for this, for the discount rate. It's a discount loan. Who remembers that from chapter 3? What a discount loan or a discount bond? What was the deal with a discount bond? Yeah, the original price. So the interest rate was embodied in the price, right? So if you wanted $1 million loan, if we're talking about it in terms of loan, this doesn't quite make as much sense. You get $900,000 today, and you pay back $1 million a year from now. So there's no interest or coupon payments. It's zero coupon. It's all captured in the pricing. You paid less, and then you paid more at the end. You pay back the coupon line. So that's called a discount bond, and that's the way the Federal Reserve does their loans, is that it's at the discount rate. And so the discount rate is the interest rate charged to member banks for loans from the Fed. The interest rate charged to member banks for loans that they're doing from the Fed. This is actually the only interest rate that they truly set, that they determine. The rest of the rates, they do a little differently with targeting and stuff. Okay, and lastly, I did this one last time too. What was the third tool of the Fed, the way that they can alter the money supply? Print more money. Some banks can do that. That can't happen in the United States. They can't just print money. There's kind of some might call a tricky way that they get it into the system. And I did it last time. The bond supply and bond demand, the purchase and sale of bonds. So remember how I had Zach buying the bond? That's our other soccer player, Zach. Zach buying the bonds and going to the market, and then the money got injected into the system. So that's called open market operations. Open market operations. And it's an open market purchase. So if the Fed buys a bond, open market purchase of a bond, does that tend to increase or decrease the money supply? Increase, right? So remember that visual. Where's my bonds today? Aha! There we go. So Eric's got the bond's out in Wall Street, Janet Yellen comes in, he's selling the bond to Jacob right now, but then I'm going to yank that sucker out. I'm going to buy with my newly printed money that I just printed off by the Federal Reserve, because they can do that, and then go buy it. And so now the bond's out of circulation, and so a Fed buying a bond is an increase in the money supply. If there is an open market sale, we're selling a bond that sells a bond, and of course that has the opposite impact. It's going to decrease the money supply. So Janet pulls out one of these suckers, hey, it's for sale, goes to Wall Street, puts it back into circulation, sucks out the money from the system. So when you think about that, just think of me being the central bank and doing that exercise, and hopefully that'll keep you straight for that. All right, questions there? Yeah.
I have a question. Nowadays, that stuff is so like electronic. Would like the Fed buy a bond through electronic, but they would send money out?
Yeah, I've kind of wondered that too, how it actually gets done. And what I've learned, the little bit that I've done on this, because this is kind of hard for me to understand too. It's a great question. Like, since everything's electronic, right? Janet's just like, oh, my broker said, hey, I want to buy this, sell this, blah, blah, blah. So when they settle up at the end of the day, those armored trucks that are bringing cash out, they're exchanging money with the funds according to their required reserves and the amount of bulk cash that they have. So it ends up leading to surpluses of cash or deficiencies of cash. And so to get cash into vault cash, the Fed gets newly printed bills from like we're going to see this on our Kansas City Fed tour. They will bring brand new bills to kind of settle up their account with the bank. But it happens kind of just as almost like an accounting thing, like, hey, we're low on vault cash. Okay, let's get some more cash in here. And the Federal Reserve actually delivers the physical cash. So yeah, it's an interesting question because you're right, everything's electronic. And then you start thinking, well, if Janet really runs the printing press, how does it actually get there? And that's the best answer I can have, because the Fed does literally truck money to banks to replenish their cash reserves. And so it ends up kind of working out in the accounting with their new cash that comes in. Okay, anything else? All right, so your textbook has kind of a nice picture for us to look at. To think about the flows. And the setup of the Fed. All right, now I almost wish I had my pointer here. Okay, so down here is the policy tools that we just covered. Reserve requirements, open market operations, and the discount rate. And then there's different areas of the Fed that take control of different things and do different tasks, if you will. So the top dogs that really run the show is the Board of Governors. So that's the board, that's the 7-member board that Wayne Angel served on. That was our OU graduate, who I hope, by the way, I didn't tell you guys this. I think I'm going to be able to get him set up to speak to our class. He's coming for homecoming, so that'll be super cool. He taught money and banking class like 4 years ago, or when we had it. Not the last time I taught it, but like my first year here, I think. And it was pretty cool. So 7 members appointed by the President of the United States, confirmed by the Senate. So this is one area that some people, whether you're a Hillary hater or a Trump hater or whoever you hate more, some people are putting some credibility into this. That, hey, if there's a Federal Reserve chair that comes up, do we want Hillary appointing that person or do we want Trump appointing that person? And so then that's part of the whole puzzle of, well, who do I hate more? I hate him more, but I don't want her nominating a Federal Reserve person, so maybe I'll do this, right? Same thing with some of the other appointments for the Supreme Court justices. That's another issue that the president has. So the President of the United States appoints the person, and then they get kind of grilled by the Senate, and ultimately gets into this group of 7. So that's Janet Yellen plus the others. And then the Federal Open Market Committee is a group of people that makes decisions directly on these open market purchase of sales bonds. And so it's got the 7 members of the board, plus governors from the presidents of New York and 4 other Federal Reserve banks. How many Federal Reserve banks are there around the nation? 12. Yes. I heard somebody say 12. Let's see, that's another picture. Let me jump to that picture. I think it might be the next one, or the next one, or the next one, or the next one. There we go. So, in an effort to decentralize things, one of the concerns that the National Central Bank failed originally is that all the action was happening up here in Philadelphia and Washington, D.C. area, right, in New York. That's where the concentration of power was back in 1776 and the 1800s, all that time, right? This is where our country really began, but yet we had people dispersed at different times throughout the whole country. And it's like, what the heck? I'm not going to let some New Yorker over here make decisions about my life when I live in Kansas City, right? They don't know nothing about Midwestern values. And then the pot smokers over here in LA and San Francisco, they're like, man, they don't know what we're all about on the East Coast, right? So there was this whole issue that we've got a really big country and potentially a concentration of power in a small geographic location over here. So what this alternative was to say, hey, let's carve up the country into 12 regions, and all of these people will have voting rights so that the pot smokers can vote, the Midwestern values can vote, the Texans, the big oil down here, the Minneapolis, Chicago, all these areas, the Floridians, they're going to have some sort of say in the central banking process of the United States, right? So that's how this all started. Now, if you look closely at that, though, this away past the Mississippi, how many banks are there of the 12? How many banks do we have over the western half of the United States? Depending on how we define west, 1, 2, 3, 4. So there's only 4 of the 12, and if we kind of follow this up through here, that represents a lot more geography than over here. But if we go back 100 years, this was 1907 when this started getting going, there wasn't as much population, right? So California wasn't nearly as big as it was, as it is now. So part of that was due to the population density that was going on as part of the reason it looks a little tilted here on the amount of coverage. But nonetheless, that was the concept, is that more geography covered, we'd be getting more input about people's values and how business is doing. So back in those days, that would give the Kansas City Fed president time to say, hey, listen, the wheat farmers have such and such going on in their lives, and it's been difficult for them to get loans for combines. And the Federal Reserve Board, New York guy would say, what's a combine? Right? And so they'd have those sorts of discussions about real cultural issues that might be happening across the country. Okay, questions or comments on that?
Have they thought about like maybe making it more even at all because there's so many banks overall?
Yeah, I think there was talks about that, and so you see these little black dots? Those are additional branches. And so they got that coverage, or a little bit more coverage, by adding some of these branches. So there's not as many of those branches over here because it's a little bit. So that was their way that they got a little more coverage of geography by having Houston, San Antonio, Denver. There's not much going up here, even if you drive it today. From Minneapolis through Montana, you can shoot a cannon a couple dozen ways and you won't as you go through here. So there's just the one. And then we've got Seattle, Portland, LA, and Salt Lake covered.
The blue ones, they all vote?
Yeah, that's where the president resides, yes. So as far as some additional powers, that's correct. But you've got basically a group of 12 economists that are kind of nerdy, geeky, don't have much political stake out there. They're just trying to do what's efficient. You know, they think they're little economic machines. So these economists will tend to listen to issues that might be going on over here as well. Okay, anything else? All right, let me go back to the other picture now that we got that background. So we've got 12 presidents of those banks. I'm going the wrong way. There we go. So the Federal Open Market Committee is going to have 4 of those people plus the Bank of New York president plus the 7 members. So those 12 people are going to get together to talk about issues of open market operations. Why is the Federal Reserve Bank of New York included? Wall Street, just because they're close. Back then. Now it's probably less of an issue. They didn't really need to be on Wall Street. But literally in 1913, 1920, 1930, it was helpful to have the Federal Reserve Bank be right on top of Wall Street to initiate those trades because it was more physical back then. It was more of the open call system and so forth. So less of an issue now, but they probably won't change it. I don't know if there's much reason to change it at this point. So they'll have these rotating chairs of 4 and plus the 7. All right, so the 12 Federal Reserve banks, each one with directors who appoint the president and other officers. So they are going to be especially contributing to rates that will be dictated to member banks for loans. So they're going to be monitoring that type of stuff more closely. Those things that are going to be more specific to banks in their region, because in theory, they're going to know those banks better. And they've done their research. They're members of their system. Did I see a hand up, Joe?
Yeah, it says that there's 2,500 member banks. Do you not keep the commercial bank, not be a member bank?
Yes. So, no, a commercial bank is a member, but there's other sorts of banks that will not be a member, but still be regulated nowadays the same way that the member banks are. So they call member banks, and they're usually the bigger banks, but it was just more by history rather than regulation. So whether you're a member or not, today you end up following the same rules.
Doesn't matter the size of some member, like,
That I don't know. I am not sure on that one. If you end up Googling it, don't do it now, but if you end up Googling it later, I wouldn't mind knowing the answer to that. That sounds like that's a good question. I'll try to remember myself, but between maybe the two of us. All right? That might be in the textbook too, maybe. All right. So then we've got the Federal Advisory Council, just another group again. 12 members, 12 bankers, one from each district. So these guys have their fingers in all of this, right? So the dash means they have their fingers in it, kind of the same crew. The Board of Governors sets the reserve requirements, so just the 7 group here messes around with that. The Federal Open Market Committee is the one directly responsible for open market operations. And then the 12 Federal Reserve banks are going to kind of really do the day-to-day grunt work, if you will, of what needs to be done with the discount rate. If somebody's getting a loan, who's actually the bookkeeper that's keeping track of that? Well, that's going to be one of those 12 Federal Reserve banks. So kind of some of those nitty-gritty details. All right. Any other questions there?
yeah, you'll be tired.
Can Janet Yellen be fired? Good question. Basically, no. She's pretty powerful. Yes, Congress can take some sort of action if it's so egregious of something she did that wouldn't cause her to step down anyway. But if there was something, there's some sort of action that can be done to move for the dismissal. But it would be kind of similar to impeaching a president. It's not going to be real easy, and you're going to have some decent evidence, and it's not going to be without a fight. And it takes a large, like a supermajority or something, that would need to vote on that to get it to pass. So for the most part, she's bomb-proof. Similar to the president, as we learned with some of our other presidents.
Our terms for life.
Oh, yeah, so I'm gonna get into that. So how long are their terms? So each of the boarders is set up for a 14-year staggered term. 14-year staggered term. I'll write that down. So this is for the Board of Governors.
That's the 7th.
Which is kind of cool. When I visited Wayne, I don't even know if I told you guys this, but some of you might have had me in class, but others of you didn't. So I went to Washington, D.C. to get some of Wayne Angel's stuff that he had because he was moving out of his condo. And then by coincidence, he was being interviewed by, I can't remember, it was CNN or Fox Business News. It was Fox Business News. They wanted him to come guest speak. So he got a black driver's car, not a limo, but like a Lincoln Town Car type thing. Came and got us, and Wayne and I drove off to the Capitol building, which was right next to Washington, D.C., the Capitol. So the Capitol building's right there. You're kind of in that whole plaza area. And then they had fairly modest building, I don't know, 10-story building or something that housed most of the media giants. So like floor 9, CNN, floor 10, NBC, floor 11, Fox, whatever. So all of them were kind of housed in this one building. And so we got up there and they did the whole thing. And as we were coming in, they would always greet him and say, "Governor Angel, nice to meet you." And that's what kind of got me off guard, because they still kind of like President Clinton, Bill, not Hillary, not thinking future. President Clinton, President Obama, President Bush, you always address them as president. Same thing with this governor. So the board of governors, it was Governor Angel, nice to see you again, glad you could come in. And they kind of did the whole makeup spiel, and we sat in the green room, getting ready for their show to go on. So on this board, they serve a 14-year non-renewable term. Now, most governors, do not serve the full term. Wayne was appointed in 1985, and he left in 1993. Why do you think they don't tend to stay the full time? Get tired of it's possible, although I think Wayne really enjoyed it. No, because they can't get, that doesn't matter for them. Remember, they're operating, once they get appointed to the position. So by the way, Wayne was appointed by Ronald Reagan. He had another cool thing that I hope we can get at Ottawa sometime, but he had a letter that was hand signed by Ronald Reagan, typed up, something that he dictated that was really personalized to Wayne when he got his nomination. So it's not that. Once they're in, they're in. But they often tend to leave early.
I'm sure things change a lot.
Like what?
Like this one, like more electronic things got.
Think about when we watched the Janet talking. What were some of the things I was flipping on the screen? Stocks, bonds, prices, markets. So if you've worked at the Fed and you've actually been with Janet Yellen having discussions about whether to raise or lower interest rates, who do you think would value that type of information? Companies like Goldman Sachs, yes. And so they might be willing to take your little Federal Reserve salary, which probably, I don't know what it is today, but I think in the past it's been, let's say, $120,000, $150,000, and instead give you a 7-figure offer. So if you've got a $1 million a year job just waiting for you versus 150 after you've done it years, and you're right, you might get kind of tired of it, tired of the BS, just like any job. That's not a bad alternative, right? So opportunity cost, once again, rears its ugly head. And it's not an ugly head, it's actually a beautiful head. But opportunity cost rears its beautiful head, and most do not serve the full term because Wall Street values them too. So after Wayne went to Bear Stearns, so Bear Stearns was a Goldman Sachs. They actually went down the tank, as you might know. Maybe some of you don't know. Bear Stearns got one of the ones that ended up going down the tubes during the financial crisis. Wayne wasn't there, by the way, at the time. So hopefully contributing to any problems that they had that I'm aware of. He was there in 1993, and I think he left in the 2000s or something. So he was there for a while. But he was our first $1 million donor to Ottawa University. So, and that's part of what created my position. So he donated $1 million back to here, And I think he probably has some change to spare. That's probably not his only million that he had laying around. So Wall Street is willing to pay a pretty good salary on top of other activities that they might be able to do. All right, so questions there? 14-year non-renewable term, appointed by the president. Appointed by the president. I'll put in parentheses here. Wayne was appointed by Reagan. So we have a little OU history since we have the opportunity to deal with this stuff.
You said Wayne was the head of the.
He wasn't the chair.
He was just the governor.
He was one of the governors,
Okay.
yeah. He was not the chair. So all of these governors get appointed this way. And the chair is chosen from the governors by the president again. That's and serves a 4-year renewable term. 4-year renewable term within their 14-year term. She's probably, I think she is coming close to the end of her first 4 years. I can't remember when she started. That'll be, I'm sure is in your book.
It was the chairman.
That was Paul Volcker. So Paul Volcker was the chair. So yeah, we want to add history here. Paul Volcker was chair during Wayne's time with Wayne. Big, tall guy. If you guys come into my office, I've got pictures. Wayne is really short. So Wayne's about, I'm not kidding, probably this tall. Paul Volcker is taller than about anybody on our basketball team. He's like 6'8", 6'9". So we had Wayne and I have a picture of those two of us in a picture. So it's like, kind of funny with the heights. So that's at a 4-year renewal term. And the term, I don't want to get this confused with this, 14-year, in fact, let me just put staggered. Let me put the word staggered in here. I don't know if I'm spelling it right. Staggered or something ER or AR. A 14-year staggered term. So in other words, 14 years, next person. Next person. Next person. So if you look at all the people, the time they get appointed is on a 14-year staggered term. Why does that go on? They're not all coming up at once. So that one president gets to appoint the whole darn board. So they try to stagger that out so that no one president has too much power in being able to appoint the whole board. All right, so staggered. I want to add a little bullet on it here. So no president can appoint everyone, unless everyone died in a tragic plane crash. Then we'd have different conspiracy theories on it. They would, honestly, they would not let them all ride in the same plane. That's the type of stuff that they do. So just like the vice president and president are, I don't think they're ever traveling together in Air Force One. So that's one of the rules. So that if Air Force One goes down, the president gets taken down, we've got the vice president hopefully ready to jump into positions. All right. Let's see. I think it's time to call it a long weekend. It's a good spot. Thank you, thank you. Mark your calendars. You're getting out early today.